Welcome to this edition of Diligence Inside America's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. Today, we're going to be talking about what should compensation committees be discussing in light of current economic conditions. And joining me is Jim Kzirian, who's a partner with Meridian Compensation Partners. Welcome, Jim.
Thank you for having us today, TK.
No surprise, we've seen the pandemic, we've seen supply chain woes, we've got inflation, we've got the Ukrainian war, all of which is contributing to a U.S. economy that many experts feel is sort of trending towards a recession. So that's news that none of us like to hear, but it's something that we all have to adapt to. So that could mean that many companies' compensation plans are at the risk of being either outdated or certainly archaic versus what lies ahead that wasn't built into the plan. So, Jim, maybe we can start this session by you painting a picture of what comp committees sort of face in the next 6 months.
Sure. Certainly, we are hearing increasingly concerns about the possibility of a recession in the near term. As you pointed out, I think various economists, and a larger number of them, unfortunately, are predicting with higher probability that unfortunate scenario is coming. And it certainly seems more likely than not that we'll be facing some serious economic downturns in the near or intermediate term. I think in the boardroom, a large portion of our clients, as they discuss incentive plan payout projections for 2022, are starting to have discussions indicating that payouts for 2022 are likely somewhat to be below 2021. And in some cases, I have clients where the possibility of a no payout seems to become more and more a reality. Now, of course, there are some exceptions to that in certain industries or for certain companies. For example, oil companies, things are booming because of the situation globally. But we could say definitively that in aggregate, overall, the picture in 2022 seems to be shaping up, as you've pointed out, to be much less favorable than what we saw in 2021, when many companies paid far above target for their bonus payouts. As a matter of fact, I had several clients with peer groups where every company paid 200% for the bonus in that year. And now things, of course, are very different. I think in the coming months, comp committees are going to face a high degree of volatility in payout projections. And I think lots of resulting uncertainty in terms of where things will ultimately turn out for 2022, and whether continued motivation and retention will be issues that they need to be more worried about. I think the idea of the Great Resignation has certainly slowed pretty dramatically very recently. The frequency of huge jumps in compensation, we were hearing at some point examples of 30, 40, 50+% pay hikes for people jumping ship or switching companies in what at the time was a very sort of fierce war for talent. I think very recently that has slowed, if not altogether stopped, as folks are really starting to get nervous about where things are going to head next. And the last point I'll make here is that, unfortunately, very recently, we've started to hear what I'll describe as preliminary rumblings of organizational restructurings, potential layoffs, and other issues starting to gain momentum in the boardroom. And that certainly fits into this prediction that we're going to have some tough economic times ahead.
So you mentioned discussions, and I know you sit in a lot of boardrooms, compensation committee meetings. So I'd sort of like to have you talk about what you're hearing in those committee meetings, okay, so far, and then maybe even more importantly, what kind of discussions should you be hearing, knowing all the things that you just outlined that are going to impact those plans for 2022?
Sure. So at this early stage, of course, we're just barely halfway through the year here for most companies that are on a calendar year, fiscal year end. We're not really hearing much in terms of adjustments per se for outstanding programs, but there is building concern, as I pointed out a moment ago, pretty consistently across most of our clients about reduced payouts, the possibility of no payouts, as I mentioned, as well as the consequence of lower share prices. Of course, the equity markets are way down as compared to where they were recently. And so what impact does that have on retention? So we're being asked for lots of what I'll describe as real-time insights. What kind of situations are our other clients facing so that companies can accurately sort of assess retention risks. Overall, though, I would say companies will face a healthy amount of skepticism in terms of adjustments to in-flight incentives. And I think the primary reason for that is, as part of COVID, many of our clients, and more broadly the markets overall, either adjusted incentive plan payouts, they may have used discretion, they may have provided supplemental equity grants in 2020 and or 2021. At the time, it was determined that that was the right thing to do in light of the pandemic. But then for 2021, we ended up in a situation where goals were set when the outlook overall was much weaker. Then, of course, we had the rollout of the vaccination and a pretty nice bounce up in the second half of 2021. And we ended up with a strong payout year in 2021. So that's sort of the context of where we're coming from. And now things have shifted dramatically, as we've talked about, for 2022. And so I think about what questions should committees be pondering? What should they be asking of their management teams? I think it's about scenario planning. So thinking through various scenarios for the remainder of the year. And I will say for a majority of our clients, those are unfortunately all down scenarios. So it's a degree of how much down do we think we're going to go. Perhaps developing low, medium, high cases, assessing the impact on the comp programs, and planning accordingly. So for example, I have several clients that had paid maximum bonus payouts in 2021. And so perhaps in that circumstance for 2022, if we're facing little or no payout, as a committee, we're likely okay with that as you think about comp programs over the long term. Another example that comes to mind, share pool. As we think about modeling how long will our share pool last as compared to what we thought when we first obtained those shares, thinking through different scenarios of share price and modeling that to sort of inform when you might go for shares again to refill your share pool as compared to what you originally expected. But I think the most discussions will take place, TK, around the go forward programs. So I talked about skepticism on adjusting in-flight incentives, but I think committees have an opportunity to reevaluate the programs for the new year in 2023. Do we have the right metrics? Should we be thinking about metrics like margin, efficiency, perhaps expense management in this environment if things turn particularly sour? And then lastly, goal setting. I think goal setting is a real opportunity for compensation committees in this environment. So what do I mean by that? A combination of things. I think it's potentially extending the outer limits of the performance curve, so the threshold and the maximum. We're starting to hear with more frequency discussions around more sophisticated slopes, so not necessarily a linear curve between, let's say, the threshold and the target and the maximum. So using curves that might adjust depending where you fall on the spectrum. And I think we'll see a lot more of that kind of action on a go-forward basis to manage the uncertainty. With regard to long-term incentive programs, and you and I discussed this as we're actually prepping for this session, down share prices, of course, bring with them a variety of issues. So I mentioned earlier, greater pressure on share pools in terms of what we thought would last perhaps 3 to 5 years now might only last 1 or 2 years. So we might end up having to go for shares more quickly than we expected. And then the LTI mix. In 2023, I think many committees will revisit or reconsider what vehicles they use for granting executives equity. Full value shares, of course, provide more stability and retention. And we saw a lot of that with COVID, companies shifting to more time-based shares. But interestingly, for those that are willing to kind of think a bit outside the box, stock options can be a very compelling vehicle in down markets. Of course, with them, they bring dilution. They bring skeptics like ISS that might not consider stock options performance-based. And I'll talk a little bit more later on about other LTI approaches that might be considered by committees in this type of environment. But I think what we can say with certainty is that the actions that companies take will be highly customized, as they should be, to their unique facts and circumstances.
So when you think of down markets, we really haven't had this scenario since 2009. We've had quite a nice run, and I'm sure that executives have benefited, from that. But it lets me get on my soapbox, Jim, just a little bit about some of the frustrations I have when people talk about pay for performance. And, obviously down cycles create challenges for compensation committees because, as you said, equity is probably down. But at the same time, the thing I want to stress is this is where managements really can sort of show their skill, okay? Somebody that manages in a down cycle and saves a ton of shareholder value, excels at all the performance indicators, like first in their peer group, et cetera, et cetera. Compensation committees, in my mind, have to find a way of rewarding people in a down cycle. Yet the conundrum of this is that as soon as you try and do that with stock prices being down, there's a swell of outside pressure that comes from proxy advisors or even other investors relative to that. But I'm hoping that with the help of consultants like yourself, that people can tell a good story, in their CDNA about how good our management team did in a down cycle and why you should reward, and if it's pay for performance, you should be rewarding those that excel in a down cycle as well as an up cycle. So your thoughts?
I think, as you fairly point out, this is probably the toughest situation that compensation committees have to deal with. But if you step back and think about incentive plans and the underlying sort of fundamentals, how do we think about incentives and what they're intended to do? One of the most important principles from my perspective is that the goals have to be realistic. They have to be somewhat achievable and viewed by the participants as being reasonable for the circumstances of that period, so that the intended incentive effect can sort of play out appropriately. So in practical terms, as I think you pointed out, that means that we could have situations where a company has a share price that's down or has earnings that may be down, and management teams expect to earn, and comp committees feel that they have to pay, let's say, a meaningful but below target payout, for example. And so this brings us back to goal setting, which I talked about earlier. If we provide more protection on the downside, let's say because of a recession, less sensitivity for downside payout variation with reductions in performance, let's say, compared to the prior year, it's really important from our perspective to make appropriate offsets or trade-offs, for example, by making the upside much tougher. So shareholders, I think, will be looking for such trade-offs to provide a reasonable structure in light of the economic reality that we may be facing in terms of a recession, for example. So in thinking through all of that, what kinds of features provide compensation committees with the tools to appropriately reward their executive teams in a down market? That's a really tough question. As I think about what are the features that we would expect to see an uptick in, I think with relative TSR plans, we'll likely see a greater prevalence, or at least committees considering more frequently what we call a negative TSR cap. So essentially maximizing the payout at target under what is likely to be a negative share price performance situation. But as you point out, still rewarding or having an opportunity for a payout for executives performing well, relatively speaking, let's say versus a peer group or versus what the expectations of the board may have been. I think performance periods may again shorten. And we saw some of this with COVID for some companies as compared to a traditional 3-year model to allow focus on more immediate priorities. So whereas when the economy is booming, our objectives might be about growth, might be about M&A, might be about driving growth and profitability. In a recession, particularly a severe recession, I think it could be efficiency, and I mentioned this earlier, or expense management, other priorities that are more immediate, that are not necessarily reflective of the long-term outlook of the company in general, but reflective of the circumstances that we're in. Overall, I think what we would say is the committee has to strike the appropriate balance between making the management team feel like they've got a chance to get into the game, even if that means down performance compared to the prior year and the circumstances we're in, but simultaneously aligning with shareholders, having appropriate offsets, such as tougher upsides to mitigate windfalls, and really addressing the possibility of the overly generous payouts if things turn positive more quickly. So it's going to be certainly an interesting time, TK, to monitor developments in the coming months. Of course, in these kinds of situations, there are no shortages of opinions from external influencers, from the proxy advisors, most notably ISS and Glass Lewis. But I think what we're going to see overall is committees being more open to unconventional approaches to dealing with what will likely be a pretty tough deck of cards that they'll be dealt for 2023, 2024, and potentially beyond. So certainly interesting times. I've talked a lot today about certain approaches that we think will be out there, and certainly will be by the sides of our clients, helping them think through these tough situations in the coming months.
Well, Jim, we're out of time, but we've only scratched the surface, and I will see if my soapbox, if I have to get back on there again once I see all the CDNAs coming out for 2022. But I wanted to thank you for taking the time and joining us, and I appreciate it. Sincerely a pleasure. Appreciate the opportunity. And that will conclude this edition of Diligence Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.